have you got any tips on, staying afloat in terms of cash flow and you want to stay in for the long term?
100%. It's all about affordable growth, really reinforcing what Rusty's just shared with us. There's always this argument about cash flow versus growth. The simple matter is, if you're in a position where your projected nest egg when you want to stop work is below where it needs to be, you need to go for growth. And as Rusty's well communicated, property is a growth asset. You'll never retire on the rent from property unless you've got umpteen properties. You'll never have the borrowing capacity to make that happen. So go for growth and then convert to cash flow, but make the property affordable to hold on to go the long distance to actually enjoy the fruit at the end. And some of the very simple techniques that you can utilize to take advantage of that. Obviously, make sure you're dealing with the right bank, number one, because there's a massive variation across the banks in terms of what the cost of those loans are. And you need to bolt on facilities like offsets. If you're investing, still consider interest only, because repayments on interest only are generally 35% less than a principal and interest loan, particularly if you've got a home loan that you're trying to pay off, because you want to be pumping all your surplus into that. And a couple of other things to make sure that you're making it affordable. Make sure you've got a rainy day reserve in your what we call the war chest that gives you some breathing space for periods like this when rates are a little bit up. But also, if you're an employee, consider getting a PAYG withholding tax variation done, because the average investment property that we look at, a $500,000 or $600,000 home, depending on what your income is, that's going to give you something like 10 to 15 grand in tax credits. Rather than wait for the end of the year to get that lump back, talk to your accountant, do a variation. 10 grand a year is about 191 bucks a week. If you get 191 bucks a week extra in your pay packet as a result of smoothing that cash flow, that's going to make it more affordable to hold. Also, look at your ownership entity structuring. So tenants in common modelling against the higher income earner can give you a significantly better boost in terms of that ongoing holding cost affordability. And circling back to what Rusty said at the start, make sure you're buying properties that are growth, but there's a sweet spot between the price you pay and the rental yield you get. So don't go and buy $1 million property, buy two $500,000 properties, and then make sure the yield's at a point where it's making it as affordable as it can to hold it while that property is growing in value. So that will be the quick maths and all of that, Kevin.
Yeah, gee, a lot of gold in there, Bushy. Thanks, mate. Hey, Eddie, the reason I love talking to you, and it's great to have you running our Facebook collective page too, is because you bring so much practical experience to this. It's based on what Bushy's just said. What did you draw out of that, and what are some of the big lessons you picked up on?
Get a good accountant and a good advisor. No, they gold nuggets. Yeah, as you said, it is paramount, and it's something when we started, that was the first thing on our minds. Cash flow wise, what is it going to mean to us on a week to week or month to month basis? That was the main thing. Forget about when you get to a point where you want to invest in property, you've realized that property is an asset class that will achieve what you want to achieve. The next question is, how is it going to impact my life right now? Because the thing is, a lot of hardworking Australians that are on decent income, they don't feel like they're on decent income because life is expensive. They usually have young kids, they start paying for school and then sport, and then so this is paramount to try and get a good grasp as to what the cash flow is going to look like. So I totally agree with Rusty's comment in terms of growth, but keeping in mind that obviously you cannot just forget about the cash flow part of it.